So I'm thrilled to have on the show today, Shawn Stewart. Now, listen about this guy for just 1 second. He's got Fuel Fitness Clubs out of North Carolina. He's got 6 locations, continuing to grow. He's been published in Club Solutions magazine twice, and they've done a piece on him. But here's the interesting thing about him is that he's like really brilliant, right? He's got a lot of information. He's got a lot of background, and he's not just someone who's come into this space trying to get started. He's actually been in the space for 25, 26, almost probably 30 years now. And he was working in executive level positions, got out of that, started as an entrepreneur, opening up mom and pop shops. Okay. But beyond that, he surrounds himself with really intelligent people beyond himself, right? Just beyond his level of intellect. He has other people that are also very intelligent. His wife is a doctor. And then he has family members who work for NASA. So he comes from a pretty good gene pool, right? And he's surrounding himself with really, really intelligent people, both on personal and on the business side. So today I've got someone very special, Shawn Stewart. He's going to talk a little bit about financing, how he gets into other locations and how he acquires gyms, how he grows his business. And he's going to give you some of the details on how maybe you can take some of this information, do that same thing for yourself. Shawn, thanks for joining.
My pleasure. Absolutely.
So, you know, I'm going to get into this real quick because I know the listeners are probably curious on how it is that you can take one club. Okay. I mean, because you got out of kind of the corporate space, so to speak, and then you opened up a club of your own at probably the best time in the world, right? In February 2020. And then COVID was going to smack you in the face in March. But you stuck with it. And then you continue to grow. You got 6 clubs. So how was it first that you had this idea that you're going to do one club, because it was probably a bit of a strain, and then you still had the vision to grow it? What's kind of the strategy there? I mean, people getting into this, they just doing one club in of itself is a struggle.
Yeah. You know, like you said, it's almost a 30-year journey for me. And I did not start off as an executive. My first job in the health club world was in 94, working at a club in Gainesville, Florida, nice, as a freshman in college, scrubbing toilets, working the exercise floor, making $3.75 an hour, and doing it in a shirt and tie, and loving every second of it. And pretty much having done every aspect of the health club business. I mean, you name it, I've done it. And a lot of things at a fairly high level. You just didn't get ingrained in the industry. And I've had so many opportunities from the people I got to work with, from Joe Cerulli in Gainesville, operating and working in those clubs for 20 years, to being the COO of a pretty large regional chain here throughout the Carolinas. But to answer your question, you know, when I was at the end of my time at O2 Fitness, this was the end, I think it was October of 19. I was at a crossroads. I had many opportunities in the health club industry, but many of them would require me to move. And as you and I talked about earlier, my wife is so important, and her career. There were places that we knew we couldn't move to, and we were happy where we were at. But I also knew, I've always had that little bug in the back of my brain that says, would you ever want to do this on your own? And believe me, throughout the years, when I've seen, again, I've been privileged to work for, you know, some of the top people in this industry and be surrounded by, you know, very smart people. There's been, most of the time I've been, no, I don't want to do this. I'm happy operating someone else's club and let them handle the problems. Let me keep doing what I do best, which is operating clubs. But I also knew if I didn't do it now, I never would. And so for a few months, that's where my focus was at the end of 2019, going into 2020. And I finally had the plan put together, and we were ready to launch in February. And as we started to put that together, that's when COVID initially hit. So I didn't actually launch what the original plan was.
Was your lease already signed?
In February. Okay. Lease was not already signed. Long story short, I had a different partner. I had a partner that was going to be putting a significant amount of money for us to do multiple clubs right at the beginning. And when the pandemic hit, he had to pull back because he made a lot of his money in the arenas that were being hit the hardest. And so we agreed, look, let's both take a step back. Let's figure out what we want to do and, reconvene once we know what's going to happen at the end of the pandemic, thinking, yeah, this is going to be a few weeks, maybe a couple months, and we'll see. Now, during that off time, when I was deciding what I really wanted to do, I was doing some consulting on the side. And I was consulting with a couple different people, and I had gotten connected with a gym in Mooresville, North Carolina, and they had been shut down because of the pandemic. And I was helping them with some things to get reopened when we started having conversations about, well, it's not really what they wanted to do. They owned the building, and there was an opportunity for me to take over that club as my first club and then kind of start this journey on my own, doing it all by myself, doing it on my own. Now, keep in mind, we're at the beginning of a pandemic. At that time, I have a 1-year-old at the house. And for the first time in 25 plus years, I did not have a regular paying salary job.
Right. And at that point. Yeah.
Absolutely. And so, but I also didn't know what was going to happen with the guy who we had talked about, who I mentioned earlier. And so I looked at it a little bit different. I said, okay, let me take this club over. Let me do it myself. We'll figure out how to make it work financially. I knew I had enough money to get it back open, to have some operational expenses. But I had to make it profitable relatively quick. Otherwise, I wouldn't have money to keep it open, much less invest in putting in the systems and, doing a little bit of a rebrand and doing the things that I feel like
make a successful health club. You're leading me right into my next question. You're at that position because this is a lot of gym owners, right? They get their first club and everything's super exciting. Some of them open with money in their pocket. And then by the time they hit month 6 or 8 or 12, all of a sudden their pockets are empty and they're trying to figure out how they're going to sustain it. Others come into it and it is a drain monetarily from day one, right? It depends on the deal that they negotiate or how they have things structured. So here you are and you're into this thing already. You probably were spending money, probably quite a bit of it to keep things moving. At what point do you say it's time for number 2? Not to go to the bathroom, number 2 club, right? So it's time for that. And you've got this second club that you're going to open. What metrics are you watching to go, all right, I've hit my metrics. I've hit my numbers. Monetarily, it's bringing enough money in, and now I can go open this second location. What is that?
Yeah. Well, and first you have to understand, doing my first after, again, 20, 25 years of operating other people's clubs, I didn't come in as this sophisticated CEO, money manager. I may have been a industry veteran as an operator, but I was an infant as an owner. I was an infant as a CEO, and I had so much to learn. Now, I was fortunate to have a lot of mentors in my corner in the industry, from the Frank Napolitanos, Blair McCaney's. I mean, I can go on and on. People I've worked for, Joe Cerulli's and Michael Olanders. And so I'd learned a lot, but there was still so much I had to learn. And so when I got started, it was a simple equation of money in versus money out. There's a lot of metrics that lead to that I eventually learned. You have to be able to tweak this and move this and make this happen. But at that time, it was a simple money in versus money out. And so, to go back to your original question, it does take some creative financing to be able to make it through those initial few months. And again, when you're talking about opening a club or reopening a club in this case, in the middle of a pandemic that it had shut down, you didn't know how many members you were going to retain. You didn't know if you were going to be able to sell members. You didn't know how many cancellations. There was so much of an unknown. And again, I was fortunate that a guy who I'd worked with for years at my previous stop, Elliot Hall, he came on board as the main operator to help help me operate, but really take the reins so I could focus on the ownership part, the financial part, figuring those things out. And he helped me get the Fuel Fitness brand launched. And if he wasn't in there operating the clubs, so number one, you got to have good people, and you got to have those people and trust who are at a high level. And again, I was fortunate to have that. Part of it there where I was hopefully smart enough to do at the beginning was to structure the initial deal so you're not bleeding cash right up front, whether that is in any financing that you have for equipment or renovations. Can you get a certain amount of time of interest only before you have to start paying the principal down? In the lease deal that I arranged, I was able to renegotiate the lease so that I had a certain amount of rent abatement. So I wasn't having to pay rent for a few months.
Do you have
and then
a
it was a
cost
ramp
per
up.
square foot on your lease? Meaning that you have a number
As far as,
right? Like it can exceed this number per square foot, regardless of where you go.
The per square foot is all based on the formula of how many members do you think you can have, how much revenue you're going to be bringing. Is this an HVLP? Is it what percentage of your revenues are going to come from personal training? So it isn't just a set number where I would say, $10 a square foot or 12. Do I have that for my formula? I do now. When you talk about, again, the money in versus money out, knowing more clearly who we are as a brand and what our structure is, I know typically what I can afford with a lease deal. I know plenty of clubs who are successful paying $30 a foot. And I also know people who aren't successful paying $8 a foot. If I can have our lease payments be anywhere from, 20 to 25% of our revenues, that's a pretty good
I'll give you an
sweet
example.
spot.
So one of the guys that I've worked with in the past, he has 32, 33 locations now. I remember he and I having this conversation. We were grabbing a workout together, and we were just, talking shop back and forth. And he said that none of the locations that he has, his average, I shouldn't say none, his average lease cost was about $7,000 to $8,000 for a location. And each location was right around 6,000 square feet. So you look at that, and he knew based on his market that he was going to go into roughly how many members he was going to draw. So that's what narrowed him into this number, right? That he wanted to hit that kind of average or under. Another group that I've worked with, I think they're at 200 locations now. When they would do leases, first of all, they'll try and buy a location. They'll buy, not just acquire the business, but the property too, right? Because if they can get in and get the real estate, they're in a good spot. But they were also in a position where they would squeeze down those lease numbers, so they'd still have 7,000 square feet, but they would pull those lease numbers all the way down as low as $2,000, especially if they were able to acquire the real estate, because they can manipulate things, in a better way for themselves. So, I asked that question because I remember reading something that you said in Club Solutions was that, the lease was the thing that you knew you could control, because once you get into the business and you start running it, it's like the thing's already signed. Like the landlord's got you by the throat. So either way, you're paying that deal. And unless you have to go renegotiate, or your 5-year term comes up, or your 7, whatever your term length is. So what would be the recommendation that you would have for people kind of getting into this? Like, lease obviously is like one of the biggest factors because it can be controlled at the forefront. What would you recommend to the people listening? Like, where should they fall? If most clubs are in that 1,000 member range, maybe a little under 800 members. So where should they fall based on the size of their facility, right? Because you got a facility size too, right? I mean, you get, if you're going to take up 15,000 square feet or 20,000 square feet, you got to fill it. What would you say?
Yeah. For me, I knew I could not out operate a bad lease. But at the beginning, I didn't necessarily know what a good lease was. But I knew if it was a bad lease, I could not I don't care how good of an operator you are, you can't out operate a bad lease. And so the first part of it is having a good relationship to make sure that you can have the dialogue in helping structure based on what it is that you have in your pro forma. If you are a 6,000 to 8,000 square foot club and you know you're going to get, 800, 1,000 members, well, there's your revenue right now. What percentage of your members are going to be engaged in personal training if that's something you do? I mean, so you can pretty easily put together a basic pro forma that says, okay, here's my revenue. Then you start chiseling off where that money is going to go. What kind of club are you? If you're an HVLP, your employee salaries and your payroll is going to be X. For me, it's going to be closer to 35, 38% of personal training payroll. Personal training payroll is going to be a little bit higher. So you just start chiseling away, and whatever number that you're trying to figure out, that's the number you leave over and say, man, I don't have any money left over to pay any lease. Okay, well, you need to maybe change the model or look for a smaller space and increase the revenue somehow. So it's a puzzle that, there's plenty of resources and people that can help you do this. But for me, it came down like when I started and I acquired the first club, I still did not have what is the brand? What is Fuel Fitness going to be? My goal was to acquire clubs at any shape, sizes, field, brand, and then I'd go in and change it to what I felt like a Fuel Fitness was going to be. So my philosophy is I will take on any club as long as it had the right lease deal and the right P&Ls, and I would do it anywhere. But that was my getting started in this business ego. I have since chiseled what I've talked about by putting together that detailed list that says, again, for me, it's based on these criteria, based on what I feel like a 20 to 30,000 foot club is going to produce, what our price point is, the percentages of breakdown between the tiered memberships, obviously personal training, having strong personal training programs. And so you put all that in, and I know on a 20 to 30,000 foot club that I've got to be around that $8 to $12 per square foot.
No, go ahead. Go ahead. I didn't mean to stop you early.
No, well, and even with that, it's going to be tweaked. I've got smaller facilities where I pay a little bit more, but it's in a higher end area. I tweak the price point to justify the higher per square foot. I've got a more of a mom and pop gym that I acquired. It's a great club, but it's in a small town. It's not going to do the volume. Again, you adjust the price point and the amenities to make up for that. But it's all within the parameters that you set for yourself. You don't always know specifically what you're going to do. It's more about what you're not going to do. And so you set those parameters and say, I'm not going to go outside of these parameters when it comes to size of the facility, the demographics, the competition, the price per square foot. Everyone needs to have those initial, 4 to 6 items that they never go outside of, and then you operate within here.
Could your model, first of all, is it 8 to 12 triple net or gross? Okay.
Both. It's I'd say our average gross is just over. I'd say it's pushing 13. But again, triple nets is I have one club that the triple nets are $7 a foot, and so to justify that, I've got to have the base. Yeah, I've got to have the base. Almost equaling the triple nets to make that work. And then you've got clubs where the triple nets are less than $2, and so you factor that in. But for me, it's when you include triple nets, when you include the gross, it's just.
So what 13. Is your escalators then? Typically, you probably sign like a 5-year deal. Standard.
I've got 1 5. Really? Most of them are 10.
Why do you go so long on the 10 year?
So another factor for people getting started versus the people you mentioned is you're in a much better position the stronger you are financially, the better history you have. So somebody who's strong financially, has 200 clubs behind them, has a great history, you're going to be able to negotiate a heck of a lot better lease deal than I am, who's opening up his first club in the middle of a pandemic with no money in savings, no history. And so there's there's things you can negotiate, but there's things that you're going to have to give up in that negotiation that other people don't have. For me, when I'm looking at certainly my signature club, for the amount of money I was getting from the landlord for the build out, plus the amount of money I was having to put in, 5 years wasn't going to be enough for either one of us. It had to go out 10 years because, I acquired my first, opened it in June of 2020, acquired the second club exactly a year later. It was June of 21, but that's also when I began building from scratch my signature club. So I took everything that I learned from the first two and said, okay, I want to build one that's from scratch, my brand, my systems, the layout that I think is going to work moving forward.
Ground up.
What's that?
So you own the real estate on it?
No, I'm sorry. I don't own the real estate. It was a shell that was delivered by the landlord, and we built out the shell. And so when we built that, obviously negotiating the TI, negotiating that structure, rent abatement, I was new to, but brought in some help, leaned on some industry experts who have a lot of experience with that. But from that standpoint, you're going to have to do longer because for the money I'm going to put into it, I didn't want to not be there 5 years from now and vice versa. So my first one was a 5-year lease, a couple 5-year renewal terms, and that made sense on both sides. I was new, they were new to it, and it was good. The second one, that was an 8-year lease, but it was, every situation is going to be unique. And so when I acquired the second club, it was a situation where someone had just bought the shopping center. So it was a new landlord and he wanted to get all the leases on the same timeline. And so if this one, had 8 years left, so when they re-signed everything, it just so happened to mirror that they wanted me on an 8-year lease. So there wasn't a lot of opportunity or options to change that. And then, I'm sorry, I've got one other 5-year lease and then one other.
What are your escalators on average?
And then 1.5% to 2%. And that's obviously going up that's, the landlords are asking for more than that, but if I can keep it at or below 2, that's good. And typically I try not to have that start at best until the first renewal or at the least after 2 years. And so one of my checkpoints in negotiating a new lease is how much ramp up time can I get so I'm not bleeding cash at the beginning of acquiring a club? Because, I'm not, especially, the first few, I'm not acquiring clubs that have a nice EBITDA and I'm giving them a nice multiple and writing a check for it. My sweet spot at the beginning was to take over more of distressed clubs and either take them over in exchange for a lease deal or pay money because they were, valued at something, but creatively work that out either with owner financing or some sort of split, some sort of escalator. And so for me, hoarding as much cash at the beginning of an acquired club is important to me. And so again, when you talk about ramp ups, when you talk about, rent abatement, having that at the beginning is very important. And that's going to help determine, okay, on a 5-year lease, we can give you this. On an 8-year, 10-year, we can give you a little bit more. But having that rent abatement and that lease ramp up, especially on an acquired club that you take over that's bleeding a lot of cash to begin with, you want to be able to have that to get to that break even and cash flow positive.
So I have a person that was, first of all, what's your typical, before I make this statement, what's your typical rent abatement period? And what do you typically get in TI?
So for a new club on a build out, at minimum, I need a year.
You get a year? Do you actually get a year?
But that's on a new club, on a build out, I would never do one.
A year from lease sign date or a year from turnover?
Okay. No, lease sign date. lease sign date, we do the build out, and then I try to create flexibility. So in the first one I did, I had flexibility that if it ran longer, that we could extend the lease period to cover that.
Yeah.
Yeah. For things that we don't control,
Permits,
which obviously there's such an unknown, and things of permits, it's gotten crazy. And then also having the ability to still have rent abatement. So a lot of times the landlord would say, okay, we'll give you a year, but if you open up in 8 months, you start paying rent in 8 months. And I always want that hard 1 year. So if I can open at 8 months, that gives me 4 months of not having to pay rent through pre-sale and through 4 months of operating. That can be big. The other thing is not just paying full rent. So in that case, I had, and really, I think pretty much all the leases that I've signed at the beginning have also some sort of escalator. So when you start paying rent, there's a period of half rent, and then 3/4 rent, and then full rent. And that's why I was saying the escalators don't necessarily kick into year 2, because I've got a lease deal. It was an acquisition. So when I signed the lease and took over the club, or renegotiated the lease when I purchased the club, I had an operating club with revenue coming in. It wasn't a new club reopening. And so the lease was, 4 months of no rent, 4 months of half rent, and then 4 months of 3/4 rent. And then going into year 2, there was 1 year of, the first year's full rent. And then the escalator didn't kick in until
so the thing that I wanted to make a statement about. So there's a woman that contacted me. She's using our software, and she had some questions about how she kind of gets into this new lease, because she was acquiring a facility. And when we sat down, I asked her, I said, did you get any TI, or did you get any rent abatement? What did you get out of the deal? And she said, well, the landlord wouldn't allow the previous owner to take their name off the lease. And so I guess, and what is TI? And so then I went through this conversation with her. I said, listen, you have a huge opportunity. I just get in touch with the landlord, sit down at lunch, and then just walk through what your plans are and show them what you want to do. Because I think there's huge opportunity for a lot of these gym owners, especially if they're acquiring, to get into a position where they're not bound by the prior rules, right? Those prior rules could potentially be the exact reason why that club is distressed, or could be the reason why that club's not making the kind of money it could be making. So what is your strategy when you go in to acquire a club? Like, is the first thing you do is get approval from the owner to talk to the landlord?
Yeah, it's Covey's age-old win-win or no deal.
Yeah.
When you can keep a negotiation transactional and not emotional, and sit down and say, here's what works for me, and if that does not work for you, then I understand. We can't move forward. And same thing, if the landlord says this is the far as I can go that works for me, and if it doesn't work for you, again, we'll just agree that this isn't the best opportunity for the both of us. And so it always starts with, what position is the landlord in to begin with? If he has a tenant, if it's a distressed club and he has a tenant that hasn't paid rent in 6 months, and he's going through the process, and he finds a good operator with a good history, there's going to be a lot of room for movement. And to speak bluntly, sometimes it's okay. You're not going to receive rent in the next 6 months one way or the other. So you can not be receiving rent from me as an operator who's going to come in and turn this club around and start paying you 6 months from today. Or you can go through the next 6 months trying to find someone else, or keep the same tenant, right, and know at that 6 month mark, you're still going to have another
and
year.
The alternative, right? So let's think about this for a second. The alternative is that potential tenant, right? Say you don't buy the club, that tenant could continue to not pay rent, becomes a problem. Now it's a potential lawsuit, right? And then that landlord now is in a position where they have to go try and release this space, which could be sitting vacant for who knows how long, right? So they're trying to capture their dollars, because they have a they have stake in the game. They have a building that they have to pay, their mortgage on, whatever that amount is, typically. And then they're relying on the tenants to be able to cover that cost. So in your case, do you typically ask to sit down with the landlord? Do you actually sit down with them, or you just throw them a deal? Like, here's my typical agreement. This is what I do.
Yeah. Early on, it would be me. Now I have a broker that I use, and most landlords have a broker. Sometimes it can be tenant to landlord relationships. But for bigger boxes like I have, the 20 to 30, 35,000 square foot, a lot of those are owned either by REITs or, bigger companies, and you're dealing with a representative. It's not an individual landlord. If you can have an individual landlord and sit down with them, that's always going to be the best. But everyone's at a different situation. I mean, I have had conversations. I had a deal that I thought was 100%. I couldn't wait to take over this club. We just had to renegotiate the lease deal. And it was someone who had not been, the previous tenant was not paying rent for probably a year coming out of the pandemic, was never going to pay rent. And he said, I'm not budging an inch. And he's like, I do not care if it sits empty for 5 years. This is the price. And somebody within the next 5 years will do it. And I said, man, that's a great position to be in. I hope to be in that position one day where I'm financially set enough to where I can have that hard line. Right. But that's an extreme case. Most of the times, and I was talking with someone, in the last year, they had a computer program that they put every factor in, and it spit out exactly what they would be willing to do. And, it was an algorithm that took into account my financial status and things that they would input, obviously the estimated time that they think it would stay open and, or go unleased, and what they'd be willing, et cetera, et cetera. And again, that was the first time I'd seen it at that level. And it was actually pretty impressive. And it was his version as a landlord, or the representative landlord, to say, that's his win-win or no deal. This is what we can do. And maybe there's a small tweak in there, here and there, but this is the basic parameters. And I wasn't close to that and never will be close to that. So why waste time going back and forth? And he was okay with that. But yeah, anytime you can sit down face to face, most landlords want successful businesses. I would assume all landlords want successful businesses, but most of them are willing to have that conversation. And if they see that you have a well operating business, in our case, a well operating club, you have a good brand, they do their due diligence at a level that they understand. Most of them you can work with, because they understand if people were in a lease pre-pandemic, and then even the things that were happening pre-pandemic with retail, especially at the bigger box level, I think there were some landlords who were getting nervous of where that would be, then going into a pandemic and coming out. Most landlords, you have the ability to negotiate a pretty good lease deal. But I always say, if it doesn't work, don't do it. Don't do it emotionally. Don't negotiate emotionally. I had a good friend of mine who I've always thought was a real good negotiator, but he said over the last 6 to 8 months, his best negotiating was throwing it into Chat GPT and spitting it out and sending that in a letter. And he's been blown away by the conversations he's been able to pull out from landlords and banks and negotiating. So even if you're green, even if you're learning like I was, there's plenty of resources out there to not go into something blindly.
That's good advice. So now I want to talk about funding. Okay. How do you get financing? This is on the minds of a lot of gym owners. Our industry is just continuing to grow. It's not going to stop. There's more people that are being born every day, right? So we're at this multiplier level where we're going to, eventually overcrowd our own country. But we're at the position where more people are also more aware of how they should exercise or what they should do to take care of themselves. And I just heard a study that was published recently where people today are now going to potentially be living to 150 years old. So those things, since they exist, and even though, most of our country, 60% of it's obese or overweight, people are giving attention to the reality that is a problem. And clubs are going to be gyms in general. Okay. Brick and mortar locations are going to continue to open up and be available. I think we're going to head into more of a tech sector over the next 5 to 10 years, but needless to say, it exists, and these gym owners want to be the ones that are doing it, right? The ones that exist today, they want to be the ones growing and expanding and, taking over a market and having their region or having a couple regions. How do you get money, right? I mean, there's a point where the banks, especially banks today, they're really tight. They've got more check boxes they got to check off. So it's even harder to get funding. I know people who've gone through SBA processes, they're trying to get a big roll of cash so that way they can go invest into multiple locations. And this process for them can take up to a year because by the time they get their new tax return, or they get the tax returns and all the financials, and the bank says, oh, well, it's been 3 months. We need your next set of 3 months of information, right? So how do you make sure that you're able to provide the right information? You have it like a packet. I knew a gentleman, he literally had packets of this stuff, and he'd just go bank to bank and try and get something done. So what's your philosophy on the best route to take to get financing so you can grow?
That's a loaded question. And so I'll simply speak from my experience. Again, as someone who didn't have a lot of money to begin with and trying to go about it on my own, it started with creative financing. And what I mean by that is, number one, coming out of the pandemic, it was a lot easier to have access to money than it is now. You're right. Banks have tightened up. I mean, I was able to get some initial financing, but when I say creative, it first starts with asking the person you're trying to get financing from, if you're acquiring a club, is there any opportunity for owner financing? Can we work out a deal? If you need X amount of down, can I pay that off over time? And so that's where I was able to acquire my first couple of clubs, is through creative financing. Being able to take the down payment and spread that out, owner financing for my second club, setting up balloon payments based on the pro forma that, okay, if you want 20% down, can I do 5 down and then, a 10% balloon and a 5% balloon a year from now and 2 years from now. So, and again, for me, it was all just based on, okay, here's what I have now and here's what I can make work. And if I really want to do this deal, here's the pro forma, here's when I know I can generate money. And there's a risk on their part, but there's also a risk on your part. I have a
question. I'm going to pause you for a second. The first question that comes to my mind is, in owner financing, in that scenario, they're willing to take that risk on you. What happens if you don't perform? What happens you get into month 6 and you've ballooned out and you have no money left to give them? What is the deal that is struck between that kind of creative financing setup?
It's really no different than what a bank would do. I mean, you set it up where if you don't pay, there's an opportunity for default, all the way up to they could possibly take that club back over. The hope is, number one, you're successful financially to be able to make those payments. And if you're not, I was in a situation not too long ago where I had a balloon come up and I said, look, man, I've got a lot of different things moving on. Is there an opportunity to take this balloon and break it up into, 2 payments or 3 payments? So you have the conversations. And anytime when you are talking about money, whether it's a bank, whether it's owner financing, if you are willing to have the conversations, most of the time there's an opportunity to work something out. Again, if you set it up and there is a situation where you may have to default, now it's up to the previous owner. Do I have the bandwidth to take this back on? And if not, then okay, well, what can we work with? Where are you at? let's open up your books and let's look at things. But yeah, I mean, initially it's going to be set up no differently than a bank. If you don't pay, certain things can happen.
So how do you, what would you say? I mean, you're at the point, you got 6 clubs, you're growing, you're looking for continued growth. You have some private equity investment. You've looked into venture capital funding. I mean, there's tons of different types of financing that exist out there. What have you explored so far, and what has been your, based on your research, what's been your kind of overall consensus of where you would naturally take this?
Before you even think about money, you have to have a clear vision of where you want to take your company. You have to have a clear vision of who you are as a business, who you are as a club. What is your brand? What does it represent? And where do you see yourself in 3 years, 5 years, 8 years, 10 years down the road? When I started off, I did not have that. So money to me probably came too easy than it should have. When coming out of the pandemic, I banked, and I'm talking about a much lower level of needing financing. I didn't need a lot of cash. I did have some owner financing. I did have some bank financing. I had a little bit of my own money I was putting in, but it came pretty easily. When I did the Signature Club, I had a lot of TI money that originally I thought I had enough TI money to build out the entire club. But then we got hit with the escalating of construction cost and delays. And next thing you know is a $55 to $65 a foot club turns into an 85. And so you've got to bridge that gap. So I went from creative financing to bank financing. I did do an SBA for my Signature Club to bridge the gap in between the amount that we got in TI to do the build out to what we needed to do to complete the project. Plus we had to finance the equipment. Plus we had to finance finishes, and we needed operating capital to get us through pre-sale and open up the gym and, get us to make sure that we ramp up to where we have, that first full rent payment is due. We have enough operating money coming in to sustain all of our expenses. And so,
I was just going to ask, as I think about the different avenues of financing that a gym business needs, right? So they're likely going to go, most of them, will go get equipment and they'll put the cardio on a lease and they'll put the strength on, a buyout, or they'll just do regular financing with it, with whatever equipment financing company they have. So you have that, and that's one payment. And then you go out and you get financing to do the build out. And then that's another payment that ensues. And then you have your lease payment that ensues, whether that balloons up or however you got that structured. What's the total amount of money that you would think to get started and to support you long enough so your business cash flows, and at some point those debt obligations fall off? So now, you're nothing but positive. What's the amount of money somebody needs to open up a gym based on your experience? Because we'll just use your gyms as an example. How much do they need to get in and live basically for that 6 or 12 month window?
If you're building a new club, then depending on the gap in the build out, but even if you include the TI, you're going to need roughly, let's call it $2 million for the build out. And then anywhere from, 600,000 to 800,000 in equipment, and then maybe another 200,000 in miscellaneous. That can be initial operating costs. That could be some finishes, payroll. Ideally, you have that wrapped in so that when you start pre-sale, and let's say you do a 2-month pre-sale and you open up your doors, you have built up your draft enough between 2 months pre-sale, and let's call it the first 2 months, first month or two, that you have enough revenue already coming in to somewhat be at that break-even level. Now, that doesn't include debt service. And so you need to have enough operating capital to include debt service. And so for me, I typically like to have 1 to 200,000 in that initial operating capital budget. And so if you're doing a bigger, nice, brand new built club, yeah, you're going to need 2.5 to 3.5 million. Now you can get a good chunk of that from TI, and then you're going to have to finance a good, either the balance of it or anything that you don't put in. Now for me, I did an SBA loan, and I did it just for that club. And that was probably a mistake I made at the time, is not including the other things that I was doing. Again, I don't know if that was a mistake or not. We'll see. But I just focused on that club. And so I did a relatively small SBA loan because I had most of the cash needed through TI and through what I had from my other clubs, and then just bridged it with the SBA loan. So that was mainly for construction and operating capital to get the business through the first 3 to 6 months. I did a separate lease deal or financing deal for the equipment, which was both strength and cardio all in one on one financing deal. And then I had some other miscellaneous things here and there, but are relatively small. They either purchased or did smaller financing through. And so all told, it was about a $2.5 million.
What's it take to start
project.
making some money from your club? Like, I mean, you went from operating clubs, cleaning the toilets. You probably worked in sales. I didn't check, but you probably worked in sales at some point. And you've done the whole process, right? And then you get into this position. This is a common thing. I recall owning clubs, and for whatever reason, the staff just thinks that you just got all this money, right? Because you build this thing. So you wait until you take your payday. Plus you got all this debt tied to you, right? And your payday is like potentially 6, 8, 12, maybe 3 years down the road. But your staff gets paid today. To your point earlier, like you finally stopped getting a paycheck, right? So what should a gym owner expect when they can start taking money home from their own business if they're building something of your size?
The first thing I would say is don't expect it for a long time. If you are starting a club, whether it's acquisition or a new club, don't expect to live off of that club for as long as you possibly can. Because even when it becomes cash flow positive, there's still going to be things you have to put back into it. And there's going to be the hot water heater that breaks, or the miscellaneous items that you need to have that fund to be able to take care of. I was telling somebody not too long ago, I was saying, I have paid landlords millions of dollars over the last 3.5 years. I have paid payroll in the millions of dollars, and that's no joke. I've paid, hundreds of vendors. I have, et cetera, before I ever took a dime. Paid the government in taxes, hundreds of thousands of dollars. So, there was so much money that goes out before I ever was in a position to take a dime out of it. And that's okay. I mean, my job is, I didn't go into this to create the day-to-day income for myself. Now that's going to have to happen, but that wasn't the intent. And because of that, I've always been in a position that if I've had the operational cash flow needed to reinvest, then I've done that. But you're right, things get tight. For my ramp up going from 1 to 2 a year later to exactly a year from the second club. So June of 2021, I opened up the Signature Club. And what I underestimated, and this is a lot to your point, is I underestimated the amount of capital needed to not just to complete it, but to have that initial operating cash flow, the debt service. I underestimated it significantly. And so now you're having to pull money from elsewhere, get additional financing. And that's where, I mentioned kind of that next level of financing. I was able to bring on a small investor and gave up 10% equity. We put a value on it. The deal was, cash plus a line of credit that represented the value of what I think the company was. And so that gave me that needed capital to just get to the point where we could reach that break even point, that cash flow positive point. But after I opened up the Signature Club, I acquired a club in September of last year, so about a year ago. So that was my fourth club that I did, just months after I got the Signature Club open, and then opened up one January 1st of this year. So anytime you have either a new club or acquired club, you're always going to have operational losses until you can build up. And that's a tough thing to measure. You hope to do that within 6, 8 to 12 months. And I heard a stat not too long ago that if you can get to cash flow positive in the first year of a new club, you're doing pretty good. Now that's all in. But I've been very fortunate. The first club, by month 3, I was cash flow positive, all in. So debt service, rent, everything. I had more money coming in than I had going out, which allowed me to do the second one, but I reinvested all of that. Same thing. That one took me a little bit longer, but about the 6 or 7 month mark, positive EBITDA, positive cash flow. Signature Club, we opened in June. In January of this year, we had our first positive EBITDA month. And February, we went down a little bit, but we've gone up ever since. As a company, I've only had 1 month since June of 2020 where we had an EBITDA that went down. So we've got a pretty good formula that for new clubs and acquired clubs, we can build that up and we're still growing. Now with a new club, because you're starting at zero, the ramp up is much, much greater. And so I hope to ramp up our revenues at a much steeper rate in the first, I look at it at the first 6 months, the first 12 months, and the first 18 months. You should have significant growth within each one of those parameters. At the 18-month mark, you're going to reach not a plateau, but what I call a mature club, where it's just, slow, steady growth. Now, some people can carry that on for a lot longer. Some of them reach that plateau a lot earlier. That's been kind of my sweet spot. For an acquired club, it's a smaller ramp up because you're not starting from zero, but it is a ramp up. And that maturity level happens anywhere between the 8 to 12 month mark. So that's kind of my formula, that if at those points I have definitely positive EBITDA, but also positive cash flow, then that's a successful business. But no, I've not been at a point where I'm able to take money out because I keep going to the next project. And you need capital, you need operating capital. Sometimes you have to take money from here and move it over to here. Sometimes you're like, okay, how am I going to make payroll next month? And then you figure that part of it out. But I'm telling you, Michael, for entrepreneurs who are starting off, there's no greater motivator than not knowing what the hell you're going to do to make it work next week, next month. And when your back's up against the wall, you figure it out. You just figure it out.
There's a buddy of mine. I told you, I think he owns like 30 some clubs now, but when he first started, he was maybe in that 8 club range, and we were having a conversation, and he said that he pays himself $1,000 a location. That was his deal, right? So I think one of the mistakes early on that a lot of operators don't do is you have employees and you have staff. You have to consider yourself as part of that group, and you do have to pay yourself, because if you don't, you end up in a position where you have spent all that money. You don't have any reserves to take care of yourself, which just puts more strain on you. Is that something that you've been doing, or is that something that you would advise?
Yeah, the answer is yes. Anytime you can pay yourself, you're going to be in a good position, because the last thing you want to do to run a successful company is to have the stress of not knowing how you're going to make things work at home. Depending on your personal situation, how you're going to pay the mortgage and those things. That level of stress you don't need when you're trying to bear the weight of the stress of owning a club and building a club and operating a club. So if you have the ability, if you don't have any other income source, so that is truly your only income source, and you need that, absolutely figure out how to work that in and put that in. And I did that at first. When I had my first club and we got it to cash flow, I was able to take a few bucks out. I've got a management company, so it was the management company that was, making the few bucks. Again, it wasn't much, but I also had another income stream. I eventually didn't have that other income stream and thought I was going to have to take even more, but that's when we did the second one. So I was in a position where I didn't have to take anything out, and everything went back into the company. And then we got to the cash drain of building a new club and what that takes. And so even if I wanted to, I couldn't. But again, anytime you're in a position to, and you can, absolutely. I've always lived by that age old philosophy of pay yourself first when you're in a position to, but don't make the commitment to own your own business if you're not in a position to have some period of time of not having to take anything out. Because the last thing you want to do is not pay an employee if they think you're getting paid, or if you don't have money to pay the bills and they know you're taking money out of the company. That's the worst thing that can happen. And so you got to be able to make that sacrifice.
Shawn, I really appreciate it. Anything else you want to add here?
No, I appreciate it. I mean, again, for me, hopefully there's some advice that I've been able to give and can continue to give based on my journey, but I'm still an infant at learning how to own and what I do best. And this is some recommendations that I would give people. If you are an operator by trade, and there's a lot of private equity money that's out there, and there's a lot of people owning and operating clubs that did not operate clubs and grow up. And there's nothing wrong with that, but there is a difference. And I'm an operator, a club operator at heart. And what I have learned over these last 3+ years is I'm at my best when I can be in the clubs and part of the operations. And that's a mistake that I have made. And again, I won't say necessarily a mistake, but something I have learned is there's too many things that I've allowed to pull myself away from that, and forcing myself and being disciplined to figure out a way to be in the clubs more is where I have gone away from and I'm working to get back into, because it's when the clubs are at their best, but it's also when I'm at my best. It's when I'm at my happiest is when I can be in the clubs. And so again, if you're new at this, you've got to learn that you may be pulled away from that, and you've got to have good operators. Again, I'm fortunate that the years I've been in the industry, I've been able to attract in the Fuel Fitness brand some of the top talent. And I would put my team right now against any team in the industry or any team I've had. And again, I've had a lot of great people, and I've leaned on them to operate the clubs, but it's still different that when the owner is in there, the culture is different, the team is different, and you got to be able to manage that properly. And that's probably the biggest thing. I appreciate that, Shawn.
Hey, if anybody wants to get in touch with you, like if you're open to like a quick text chat or a LinkedIn chat or email chat, where can they find you?
Yeah, I'm open. If you want me to give my email and number and everything,
number, but maybe your email and I know you can find you on LinkedIn. So it's Shawn Stewart, Stewart. But yeah, if you could give your email, that would be good. I think people would appreciate that.
Yeah. So my name is Christopher Shawn Stewart. I go by my middle name, Shawn. So you may hear both depending on the publication. But my email is Shawn, SHAWN .Stewart, STEWART @fuelfitnessclubs.com. And yeah, I'm on LinkedIn. I'm on social media. I'm not on there very often. If you do reach out on those, it may take me a while, but I will get back to you. But yeah, I look forward to conversations and look forward to seeing people and talking to people at many different industry events. Again, this is awesome. This is what I do.
Shawn, thanks so much. Everyone, you heard it here from Shawn. There's some information about funding and how you get how you can negotiate the right deal. We got into leases. I didn't expect to talk about that, which was really nice. And where you can go to get money and how you kind of need to think about money and capital and how you fund your business to grow. Shawn, thanks so much for being on the show today. Everyone else, thanks for listening. You can always check the show notes. If you want to book a demo with BizOps, go ahead and click that on the show notes. If you want to reach Shawn, his information will be there in the show notes as well. And I'll catch everyone on the flip side. Thank you.
Awesome. Thank you.